candle formed from when the market fails to make a lower low. And then a bearish breaker block is an up close candle formed when the market fails to make a higher high, right? So instead of taking, let's say in a bearish environment, remember with a breaker block, we are going to take out an old swing high, and then we continue on the downside and then retest that candle that was used to go up and take out the previous high. With the mitigation, it's not like that. The market will fail to take out an high, right? So let's demonstrate that. This is when we are looking for longs, or we are looking for bullish market conditions, right? So if you look at the current example, you'll realize that what price did was they came and then they failed to go lower than the low. So that means this is a failed swing low, right? They did not go to they did not make a lower low type of pattern or environment. So what we do is we are going to look at the last up close candle movement to retest this order block over here, this right here. Then we extend this to the right. If you look at this, you'll see sensitivity, price came, then went up. So what does that mean? This means this is our mitigation block. And then you continue extending price to the right. Price came back to this block over here and they found support. They went to the upside, right? If we continue, okay, they did not test the mitigation block here, but rather they used this order block. So this is how mitigation blocks work. Remember, failed lower of no, it's not a lower low. They came and then it's a failed swing point, and then they went up. We used the last candle that was used to push price down as our point of support. Now let me clarify this on a bearish environment. So on a bearish environment, you realize that what price did here, instead of coming, we had this swing high and price came but failed to take out the swing high, right? So this is a failed swing high. What we do is we look at the last down close candle that was formed before price went up. So this candle right here, if we extend to the right, price took it out here, and then what they did is they came, let's extend again, extend to the right, they came and found resistance on this level, right? They went down, they came again, they still found resistance on this level. They went down, they still returned and found resistance on the same level. So that means this level is powerful. So we call this right here a mitigation block, right? So when ICT describes this concept, he explains that this is when everyone who was long here and they are underwater here, what they do is they're going to take the market higher so that they reduce their losses on this candle or on this level here. So we call that's why it's called the mitigation block. They are mitigating their losses from the marketplace. So if I go back to the bullish mitigation block, all the sellers here, everybody who sold this up movement here, what they did is when they pushed price down, and then when it went up they were underwater, and then when they pushed price down and tried to mitigate their losses on this level here. So basically